Today, we are addressing the aggressive positive rebound we've seen in the stock market over the last 3 months. Ever since the April 2nd bottom, when Trump first announced his tariffs, the S&P 500, for example, is up 22% in just 3 months. We are going to talk about why we might see a pause in this higher move in the stock market, and we could even see a 10% sell-off from today's levels. And the whole time during this video, I'm going to pose some alternative ideas. We can buy something other than high growth tech companies, which might add some safety to your portfolio during these stressful times. And before we get to the bulk of the content, let's just give an update on the growth on sale portfolio and the recent update we have, and that is the buy of Adobe stock. Now, you're going to see the lessons that I make in these videos also portrayed in this portfolio. Now, today I'm harping on about maybe tech companies don't have to make up 100% of your stock buys, and this portfolio directly reflects that, with around 50% being made up with health insurance with United Health Group, but also Kimberly-Clark, basically a toilet tissue and detergent company for businesses. Those two names add defensiveness to the price moves in the portfolio while adding in a decent dividend yield, 2.5% for United Healthcare and around 4% for Kimberly-Clark. And we can see this play out in the stock market just today. So what I've got here is a list of big growth tech companies on the right, just my watch list. And then I've got all of the price indices and crude oil and stuff on the left, and you can see here that tech had a pretty disastrous day. We only had a few green names, but Meta, Facebook stock was down 2.5%, Tesla was down 5%, AMD down 4%, Nvidia down 3%. Now, a lot of those companies are potentially great buys for the long term, but if we do go through some weakness in the market for about a month, a 10% drop in the S&P 500, some of those companies could be down over 30%. And this is where I'm going to contrast now my dividend company watch list. I don't actually own 100% of these companies. These are just the ones that I think are interesting right now. And what's funny here is I just screenshotted as many dividend companies I could fit on the screen, and every single one of them are positive today. And this is again at the same time, many tech companies are in the red. For example, Target, I believe they're dividend yielding over 4, maybe 5% now. Target is up 5% today. We have Whirlpool, 3.8% high, like a 7-8% dividend yield. AbbVie, around 5% dividend yield. They were up 2.5, I think, percent today, if I can read that. So a lot of safety in terms of the price action, but you're also getting a giant dividend yield every single quarter. But we can move on to a broader picture of the S&P 500, because we don't just care about one company, we care about what the whole market is doing. And the S&P 500 recently just took out the all-time high. Now, this is important for many reasons, but I'll talk about 2 here. Now, the first reason is we used up a huge amount of positive move high in price to get to the all-time high. Again, 22% in just 3 months. That's a huge move. And once you've exhausted a bunch of your price increases in stocks, valuations are pushed to the extreme in the short term, you're not very likely to see that continue on and on again. But once we've hit those all-time high prices, what's the next goal for the market? There is no clear 6,000 price target. Already taken that out. Maybe 6,500 could be the next one. But that's, whatever, 5% higher from today's levels, a very aggressive move. And we can also talk about this in terms of the valuation story. We are now pretty much sitting on a forward P ratio of 22. And the way that these are quoted are operational PE ratios. So they look at the operational profits for the next 12 months, and then you divide the S&P 500 price by that. So that does not include tax or interest on debt. So really the 12-month forward P ratio that we would usually use for stocks is something like a 26. Now, this type of P ratio, if I was going to apply this to an individual company, then I would say that I would be expecting about a 15 to 13% profit growth rate in earnings per share growth. And I just don't think we're going to see that over the next couple years for the broad stock market. At the moment, the market is still expecting a pretty decent 2025. We are expected to slow down towards the end of the year, maybe mid-single digit growth in earnings, but then in 2026, all of a sudden, we're expecting 14% higher growth in profits. Yeah, we have tech companies that make up a larger slice of the entire market, something like 30-35%. However, I just think we're getting too aggressive with these profit growth expectations, especially as names such as Google, Amazon, Nvidia, these big giants that have carried the market, they're having their profit growth slow down moving forward, not getting faster and faster. And we can look at this in a few different lenses to get a nice broad measure. So this next graph here is looking at the earnings guidance that's been issued for the upcoming earnings season in about a month. Now we see here in green, the first column, technology companies had around a 27-28% increase in their positive guidance. That's in terms of the number of companies that have issued positive guidance. That usually meant that those companies had a great quarter and they're forecasting good quarters moving forward. We have also had the same type of commentary from industrial companies, healthcare companies, and also financials. A lot of people might take this as positive news, but I'm kind of a contrarian viewer of the market. If we have a huge amount of positivity baked into the pie, there's just not much positivity left. So if we have extreme positive guidance moving forward, it just makes the hurdle higher and higher to jump over, and we are at risk of failing to meet that hurdle. And we can see this reflected in just one more graph here. This is the percent of S&P 500 companies where analysts have majority labeled them a buy. So we actually hit lows in this measurement back in August, September of last year. Around 53% of S&P 500 companies were worth buying, according to analysts. But now we've gone up, skyrocketed higher, up to a 56.5. And that's even with all of the tariff stories coming out. We've barely budged from these decently high levels. We've just come off one of the most aggressive moves higher that we've seen really since probably 2021. Seeing all of that evidence so far, that doesn't mean we're going to have a giant sell-off right now. All it means is the next time we have a bit of negativity in the market, I just see the downward moves as being larger than usual. So for example, if we have a little rumor in the market that the tariffs are coming back or interest rates are going to stay higher, instead of the market moving down 3, 4, 5%, now we're going to see a 10% move. All we've done is covered the pile of wood with petrol, gasoline, and all we are missing is the spark that will send us moving in the market. The first big negative is the tariff story. Now, we did bench that for 3 months, or Trump benched it from really the 9th of April, but his 3-month pause is expiring in the next week. In summary, at the moment, we have a 10% broad tariff for all imports coming into America, and there's a couple little individual deals with countries, I believe, Canada, Mexico, and stuff like steel and aluminium imports. However, with the tariff deals expiring, there's not much clarity about what the next phase is going to look like. Are we going to go back to the April 2nd tariffs? That's kind of the message that is assumed right now, but those tariffs were extremely aggressive. Just a reminder, we had a 46% tariff on Vietnam, 25% tariff on India, 36% on South Korea. And there's been a few countries that have come out with negotiations. The UK, I don't think the China deal was finalized, or it wasn't very impressive from memory. So overall, we're not getting a hugely positive storyline here. High tariffs means higher inflation, and that hits the profit margin of companies, but also the savings of individuals like you and me. So maybe Trump has a plan there about how much he's going to tariff the world, what that's going to look like. But either way, if those tariffs are not 10% or better yet 0, we're going to have a lot of negativity in the stock market. The second catalyst is actually attached to the first, and that is about the interest rate story with the central bank. Showing up a chart here, we've got a probability distribution of what's going to happen in the next Fed meeting. We've got a 78% chance of the Fed keeping interest rates the same, only 21% that they're going to get lowered. So overall, we're still expecting interest rates to remain where they are. The good news is by September's meeting, we're expecting another rate cut, which is great news. But we've been on pause here at 4.5% as the baseline interest rate in America for around 8 months now. Now, I've got one story here why that interest rate pause of 8-9 months is absolutely critical. We should have been at a central bank interest rate of around 3.5% or 4 more cuts in the last 8 months. However, what we've really done is force corporations to reissue their debt over the next couple of years at a higher rate. We have $1.8 trillion of corporate debt that needs to be recycled. In other words, they borrow money for 10 years, back in 2015, that due date is coming up. They need to actually take on brand new debt, pay back the money they owe to whatever investor, and basically we just recreate the cycle. There's constantly debt that's recycled in the economy. The only thing that changes slowly is the interest rate. But the thing is, many companies reissue debt at extremely low interest rates during the COVID lockdown period. Companies could loan money at 3%, 2% during that time period. However, now we're looking at 6, 7, 8% interest rates. In the next 18 months, we expect 15% of all corporate debt having to be reissued. Again, that would likely double the debt payment load for those companies that need to reissue. The bigger the company, the safer they are, and typically today, also the leaner they exist. If you have a company like Google, AMD, Adobe, they don't have a lot of debt. They didn't need to buy up billions and billions of dollars of assets, building up hardware. They have a little bit, but not a huge amount. If we contrast that against many smaller companies that need to take out lots of debt just to get started, or asset-heavy companies in the S&P 500, maybe think of your Boeings, your industrial companies, maybe your energy utilities. In summary, I still see fast-growing tech companies as a great place to be in the long term, but there are little spaces in the market where there's opportunities to kind of hide out during a downturn. So for example, just showcasing what I mean, I've got here 2 tech companies that are kind of the traditional safe harbors, or at least people love them. We've got Apple and Nvidia. Now, Apple is only expected to grow about 9%, 8% over the next year, P/E ratio of around a 27. That's not the best attractive offer there for the P/E ratio for the growth that you're getting. With Nvidia though, they're expected to grow around 40% in the next 12 months, and their P/E ratio is around a 31, a bit better of a proposition. Again, reiterating the message from earlier in the video, those companies are great, but if we do have a downturn, expect about a 20-30% drop. I'm not saying recession, that would be a 50, 60, 70% drop in those big tech names, and we need at least a small part of our portfolio to hide out during the storm. And I've got 2 names here for you. I own one of them, being Kimberly-Clark. Again, that's a consumer discretionary company. So again, detergents, toilet paper, all that stuff, mainly for businesses. 7.5% growth rate at a 16-17 forward P ratio. It's a true dividend payer, extremely safe. And if there is a sniff of recession, people just dive into Kimberly-Clark again. And another one is SJM Smucker. So they're a food-based company, kind of packaged food. They're expecting to grow 7% over the next year with a forward P ratio of only a bit over 10. So again, a safe dividend company, both yielding over 4% at decent valuations, contrasting that against the current risk in the market being overpriced tech companies. Thanks for your time today, guys. Subscribe if you haven't already to follow the journey and follow the growth on sale portfolio. See you next time. Bye.